Other types play a critical role in managing investments, which different strategies requiring different approaches to others. Whether you are engaged in short-term, trading or long-term investing, selecting the right order type can help you manage risk, execute trade effectively, and align with your investment goals. I want to talk about the role of other types in short-term versus long-term investing strategies. The role of other types in a short-term versus long-term trading strategies or investment strategies. Let's consider short-term investing. Short-term investing, including day trading, swing trading, or momentum investing, typically involve making quick decisions based on market movements. In this context, certain other types are used to capitalize on small price fluctuation. Let's look at market orders. Market orders. In short-term strategies, market orders are often used to quickly enter or exit a position, especially when speed is crucial. Market orders guarantee execution but not the price, making them suitable for fast-moving markets where price slippage is minimal. Let's also consider limit orders. Limit orders actually, are often used in short-term trading when the traders want to buy or sell at a specific price or better. Limit orders allow traders to set their ideal entry and exit points, avoiding the risk of unfavorable prices that could occur with market orders. You want to buy at a particular price, you want to sell at a specific price, you key in a limit order and your orders will be executed at that same price. Let's also consider what is called stop loss orders. Stop loss orders. These are often used in short-term trading. It's equally employed, even in long-term trading as well. It is employed to manage risk, in a fast-moving market. Stop loss orders are frequently used to automatically, sell a position if the price, falls to a certain level. This helps traders limit losses and protect gains from sudden market reversals. You want to employ a stop loss order. Let's say the stop loss price is maybe $2. Once the stock falls to $2, the system will automatically sell off your position and you will not incur any further losses, or you could lock in profit as the case may be. So trailing stop orders, and these orders are useful in short-term strategies where profits can be localized. You want to, localize your profits to a particular price. You want to, lock in your profits to a particular price. And then in that case, you utilize a trailing stop orders. The trailing stop moves up with the market price, ensuring gains are protected if the stock reverses, a direction. When you put in a trailing stop orders, you discover that you could, quickly lock in your gains. In the case where the stock, decides to plummet, you will not incur losses as a result. Let's look at long-term investing. Long-term investing here, long-term investors generally aim to hold positions, over months or years, focusing on the long-term growth potential of stocks or other assets. Their other strategies are often, less urgent, with a focus on minimizing transaction costs and ensuring alignment with investment goals. When it comes to long-term, investing, you don't really bother so much about setting, limit order or whatever. You simply invest for the long run because, as the case may be, whatever order type you tend to employ will not affect your investment, over the long run. Let's look at uh, market orders in this context. While market orders can be used in long-term investing, they are less common since the price at execution isn't as important to the long-term investors. They may use market orders for initial investment, or if they need to quickly execute a trade in a low volatility market. So the kind of order employed is immaterial because you're investing for the very, for a very long time. Let's look at how limit orders come in here. So long-term investors typically use limit orders to enter positions at specific price levels. This allows investors to wait for a favorite price rather than buying at the market price, which may be higher than desired. It also helps them avoid overpaying for an asset. When it comes to long-term investing, a limit order could then play a crucial role compared to market orders. You don't want to buy an overpriced asset. Don't want to buy at a price you consider too expensive. So you could set in a limit order in this context. When it comes to buy and hold orders, what is called buy and hold, orders. For long-term investors, there's often there's often no need for frequent orders. So once a purchase is made, the investor may set a stop loss or trailing stop to limit losses. But generally, the orders are not frequently adjusted, as the goal is to benefit from long-term growth, and dividends. When you consider, the buy and hold strategy, so in that case, we are not so much particular about the kind of order you adopt, because you are buying for a very long time. You are buying to, you are adopting a buy and hold strategy, and so other types are not very, very important in this context. Let's observe, dollar cost averaging. Dollar cost averaging. While not a specific order type, long-term investors may use automatic investment at regular intervals, buying a fixed dollar amount of an asset regularly, regardless of the price. This strategy reduces the impact of short-term market volatility. When it comes to dollar cost averaging, you simply buy, a fixed amount of you allocate a fixed amount of money to buy assets regularly. Whenever the price is high, you buy. When it is low, you buy. But you do it regularly using a predetermined fixed amount of money. So let's look at the key differences in order type for short-term versus long-term investing. Key differences in order types for short-term versus long-term investing. Now, in this case, you consider urgency. Short-term investors need orders that allow for quick execution, such as market orders, while long-term investors are often more patient, using limit orders and only entering trades when conditions are considered favorable. Don't really bother so much about, for long-term investors, they don't really bother so much about the kind of order they use, because they are there for the long term. They may utilize limit orders, but that really doesn't really make much impact over many years. When it comes to risk management, stop loss orders are more commonly used in short-term strategies to limit losses during volatile market conditions. So long-term investors may use stop loss orders more conservatively or rely on general market trends to make decisions. As a trader, you need to employ stop loss order so as to be able to mitigate risk on the downside, so that you will not incur losses that are more than what you could bear. So you set a stop loss, and when the price gets to that part, when the price gets to the particular, when the stop falls to the price you set, then the system will automatically dispose your shares. So we also talk about cost consideration. Short-term trading involves more frequent transactions, leading to higher transaction costs. So other types, like limit orders and stop loss orders are useful in minimizing the cost. Long-term investors usually incur fewer transaction costs due to less frequent trading. And not only that, we consider price sensitivity. Short-term traders are more sensitive to price movements and timing, so they focus on using orders that optimize entry and exit points. Long-term investors, on the other hand, are typically less concerned with short-term price fluctuations and are more focused on long-term growth. So when it comes to other type, it varies from long-term investors to short-term traders. Short-term traders are more concerned about other type, particularly when it comes to stop loss, order. But for a long-term investor, you're not really much bothered about, setting limit orders, or you may simply go with a market order. You don't really bother so much about setting a stop loss order because you are investing for a very long time. So in conclusion, the role of other types in short-term versus long-term investing strategies, is primarily influenced by the time horizon and goals of the investor. Short-term investors need quick execution and tight control over their entry and exit, and are often using market limit or stop loss and trailing orders to be able to have real control over their investment. In contrast, long-term investors prioritize price efficiency and low transaction costs, relying more on limit orders and infrequent trading to align with their long-term long-term investment objectives. So these other types play a very important role, particularly when it comes to short-term investing. When it comes to long-term investing, well, you may choose to go with a typical market order. You may employ a limit order, as the case may be, but you're not so much concerned about the other type because you're investing for the long run.